sound money is not just a novelty, but it's what should be money to start with.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi there, my name is Shane Morand, and I'll be your host for this week's episode of Live from the Vault. So welcome to the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Now this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the house. And to help him pull back the curtain, we'll be joined very shortly here by Mr. Daniel Lacalle. You'll get to meet him in a second. That's right, Daniel Lacalle is in the house. You're not going to want to miss this conversation here. But just before we get started, please help us spread the word about this channel by hitting that like button, by sharing, and by subscribing. And if you've already subscribed, if you want to hit the bell right there, we will notify you as each of these episodes goes live. So let me tell you a little bit about our guest today. His name is Daniel Lacalle. He's a Spanish economist, and he has worked as an investment manager and a professor of global economics. He's the author of several economics books, as well as being a columnist, contributor to various print and digital publications. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our special guest, Mr. Daniel Lacalle. Over to you, Andy.
Well, Daniel, it is a real pleasure. Thank you very much for spending the time, taking the time to join us today. You have a huge following out there, very well respected. And while we sometimes are a little bit, polarized to just gold, all the crosses are so important that also influence gold. So I'm going to take this opportunity to ask you what you're seeing on a much more wider basis, and that would be just great to get those. Our subscribers really, would appreciate that kind of information. And today, and I just want to make, because this will be published a little bit later, I just want to let everyone know that we're recording this episode, I think, just under 2 hours before the FOMC announcement. And I think the market appears to have baked in. I'm going to ask you this question about this, but appears to have baked in a 25 basis point hike with the general consensus is future hikes will be data dependent. But Daniel, however, following such a rapid period of rates being too low, and then a rapid period of or a long period of too low, and then a rapid period of rising rates. I mean, does this not risk a potential further banking contagion over and above what we've just witnessed?
Certainly. Thank you so much, Andrew, first for this opportunity. It's a great pleasure to speak with you. What we're seeing right now is unprecedented. We have gone from excess on the supply side to excess on the contraction side. And I think many of the people that are watching us right now and listening to us will understand why the Federal Reserve is making two gigantic mistakes in such a short period of time. And it's because it's now almost 2 decades that the Federal Reserve and the major central banks of the world don't pay attention to monetary aggregates at all, to the point that, as our viewers will know, is that the United States doesn't publish M3 figures anymore. And when you don't pay attention to monetary aggregates, you make mistakes on the way in and on the way out, which is what is happening right now. The Federal Reserve made a gigantic mistake thinking that there would be no inflation when they increased money supply by 5 times more than what we considered already an excess. No. And they're making a gigantic mistake by hiking rates while at the same time being hugely accommodative. Because this is another important thing, is that the reduction in the balance sheet of the Federal Reserve is not just going slow, it's going massively slower than what it should be. No? So what is going on right now is particularly concerning for a very simple reason. As you know, if we want to curb inflation, there are three things that need to happen, and all of them at the same time. First, you need to hike rates. That is true. Second, you have to reduce the balance sheet, the amount of money in the system, the quantity of money in the system, the balance sheet of the Federal Reserve, if we want to call it that way. Third, you need to reduce government spending, which is what created the money excess to start with. This third part is not happening at all. And this is a huge problem because the entire burden of normalization is falling on the shoulders of families and businesses, which obviously are the fabric of the economy. Therefore, what we are living right now is, on the one hand, a GDP print that is not particularly negative, that looks even positive, a certainly apparently robust labor market that, on the other hand, shows negative real wage growth, so not that robust, no? And a government spending that is not even scratching the surface of reduction. Therefore, there's more units of currency in the system. That's why core inflation is elevated. That's why prices are declining on an annualized basis. But remember, in June, prices rose. No? So the environment right now is one of disguised normalization, I would call it.
Interesting. And I think what you're just outlining to me, and again, I'm not a specialist in the subjects you're talking about here, but it's what it does is raise questions in my mind. Is the belief that US Treasuries are a risk-free asset class? I mean, look, if the US government can't repay its debt, and is a default not inevitable? Especially as I understand, in 2022, wasn't that the worst year for US Treasuries in American history?
It was. It certainly was. And 2022 basically completely debunked the entire fallacy of MMT, the so-called modern monetary theory, which is not modern and is not a theory because it's been implemented for centuries all over the world, printing money for no reason. No? But it completely debunked. We saw how bonds that were supposed to be risk-free fell in the market as much as risky assets. We saw the currency in Japan collapsing to 40-year lows. We saw the currency in the UK, also a very stable currency, also declining quite severely. So a number of things. There are a number of alarm bells out there that are showing us that it is completely incorrect to think that sovereign bonds are a risk-free asset. And more importantly, if there is one element of evidence that tells us that although it might be demanded, it continues to be extremely weak because of the challenges on the fiscal front, then we start to understand why we have so much volatility. It's showing us that there is no such thing as a risk-free asset. There is no such thing as the concept of government spending and deficit spending creates reserves for the private sector. It's a completely ludicrous viewpoint that is predicated on an analysis of the economy that is upside down, that is thinking that wealth and progress comes from government spending and debt, not from investing and saving. No? So very concerning environment, I would say, because we are starting to see something that many people did not even fathom, which was that we have seen the Federal Reserve and major central banks hike rates. Okay, fair enough. But rate hikes have made credit demand plummet, both in the United States and in the euro area. And at the same time, inflation remains extremely elevated. So the narrative has changed. The narrative has changed from combating inflation to making people believe that 3-4% inflation annualized is a success. And it is not, obviously. It is a massive wealth destruction with negative real wage growth, with negative returns, obviously, and loss of purchasing power of the currency. So we're living in a slow but almost relentless debasement of fiat currencies.
That absolutely makes sense. So, and interestingly, I mean, there's obviously I always try and equate what's going on to gold as well. And so interestingly, as you say, sovereign bonds, sovereign treasuries are not, as many people seem to feel that it's a first-year asset class. But as of the 1st of January of this year, Basel III NSFR standards came in, where over-the-counter foreign exchange gold, i.e. gold that is traded against the dollar, the euro, et cetera, held in that lands in London, has to be one-to-one physically backed by bullion. Now, interestingly, we're finding a lot, and we have connections with a lot of large clients, first-year banks, et cetera, who are saying that, yeah, you know what, we're actually seeing some diversity into, whereas with NSFR Basel III NSFR standards in place for gold, it is also become a first-year asset class. Now, if you're dealing in physical gold, that has zero counterparty risk, absolutely zero counterparty risk, because all the energy that went into making it is already paid for. Therefore, what's your thoughts?
I completely agree with you. The only risk that you have with physical gold is obviously the fact that it is physical, that it's difficult to store, and that, as we have seen, unfortunately, at least once in history, is that it can be confiscated. Mm-hmm. And we should not forget that in an era of financial repression. But what I think is very important about what you just said is the underlying trend of what is changing in the central bank world relative to gold. We have seen for 2 consecutive years a record purchase of gold from central banks that was actually even considered as ludicrous a few years ago. A few years ago, you might remember that there was an entire debate saying that it made no sense for central banks to hold gold as a reserve. And what we're seeing is the opposite, which is it truly interesting, because it means that something is changing. The Chinese central bank does not trust the US dollar entirely as its main reserve base. Same thing happening with the Russian central bank, with many other central banks all over the world. So on the one hand, we're seeing a massive purchase of gold from central banks. On the other hand, the move to physical gold is strengthening relative to the belief that I, for example, lived a few years ago, 10, 15 years ago in the market, where what people said is basically what you have to do is buy an ETF. Everything else doesn't matter. No? And the reason why we are seeing such massive purchases of physical gold is because a lot of central banks, after the decision to freeze the accounts of the Russian central bank and other monetary measures because of political purposes, etc., are basically starting to get exceedingly concerned about the possibility that the units of digits that we own in our accounts can vanish very, very quickly. No? So a lot of people that I speak with say, well, but this would be like going back to the old times, having coins, in the basement and all those things that have nothing to do with modern money. No, it has to do with real money. Huh? Real money is not a paper or a digit, or is something that we can exchange for goods and services in a difficult period of time. And if anything, all this process is showing that gold is real money and that everything else is credit, as J.P. Morgan was, I believe, quoted saying.
Yeah, and I think this is this is interesting, because I think we see this pivot point, so many things coming together at this point. So the very fact is that when the Bank of International Settlements, who traditionally had swapped 700 tons of gold, in fact, in the last year, as just before, by November of 2022, they covered all 500 tons of swaps, got rid of all their paper gold exposure, and literally and that really reflects what we're seeing at other central banks, and what you've just outlined as well is plenty of other central banks are saying, you know what, we need a hedge here. We need a bit weaponization of the dollar. Anything could happen. It's happened to us once before. Once bitten, twice shy. So it's evolved. But what's interesting to me, because obviously we're so close to gold all the time, what's interesting, while this is happening, while this is going on, then you look at the current ratio of gold to foreign debts outstanding, US Treasuries. It's under, in fact, it used to be 6%. I think it's closer to 4%. But even accepting this unadjusted level, 6% level, the ratio used to be 20 to 40% as a historical average. And so I think the Bank of International Settlements, looking forward, is the diversion from what the Fed seems to see. Ultimately, I think they ultimately expect that after Basel III. So if we restored, I'm just looking, and I'm not saying this is going to happen, guys, but if we restored 20 to 40% ratio of gold to foreign debts outstanding, that puts gold at about $6,000 to $12,000. I mean, and in 1981, that went up to 140% collateralized by gold. So, I mean, talking 40 grand, and I'm not saying that those are realistic numbers, but it has to be put into context with, why is the Fed so out of touch?
Well, to start with, the Fed doesn't look at the price of gold at all, at all. And to the extent, and I've had the pleasure of meeting numerous members of the Federal Reserve and other central banks. None of them even consider gold at all. They may talk about housing, they may talk about stocks, they may talk about bonds, but never about gold. And it comes back to what we were saying before. They stopped talking about monetary aggregates, or at least considering them, and they stopped as well thinking about gold as money or as an asset to compare, as you very well did right now, with outstanding levels of debt or the outstanding or I remember when I started in macroeconomics, when central banks used to actually measure the percentage of gold relative to total reserves, which actually from a central bank perspective would make some sense. No, because they obviously don't care about debt as much as they should, but they certainly care about reserves. No? So what is going on is basically evidently clearly a level of denial about what is going on and the diminishing returns of expansionary monetary policy. Okay, if we look at money in history, what has happened in the last 20 years is an anecdote. It's nothing. No, so it's so frustrating to see academic works and central bank works talking about what is going on in the monetary system, looking at 30, maybe 20 years maximum, which is irrelevant, to be fairly honest. No? That's why they made the mistake of saying that increasing money supply would not generate inflation. because the period of time that they looked at to analyze that causation was so small, was so absolutely minuscule compared to history, that it was statistically irrelevant and definitely, from an empirical perspective, completely ludicrous. Coming back to your point, the level of appreciation opportunity of gold is quite significant. Absolutely, it is. But what we cannot deny is that gold, if the Federal Reserve pushes the world into a deflationary spiral, gold is not going to achieve that potential in terms of absolute price very, very soon, because all asset prices are relative to something. And we may actually see something that looks illogical, but that makes sense on a relative basis, which is the strengthening of the US dollar. Okay? Only because it's not because it's the best asset in the world, is because it is in a fire the house with the largest number of windows and doors. It's liquidity. And the big problem that gold has to achieve its price potential steadily and quickly is liquidity. Is that we have discussed before the importance of physical gold relative to ETF gold, no? Because everybody understands that if we have another financial crisis and there's a collateral risk of your counterparty or your prime broker, it doesn't matter if you own ETFs in gold or in the Nikkei or in the S&P 500. It's exactly the same, nothing, no? Mm-hmm. So I think that it's the liquidity aspect that makes gold take longer to generate its, let's say, price potential relative to what we see in the economy. However, what is interesting at the same time is not to look at gold in US dollars alone. Mm-hmm.
Yeah.
Is tell this that we're discussing right now to anybody that is watching us in Argentina or in Venezuela or in Iran or in Turkey, is the number of fiat currencies that are completely being destroyed relative to the dollar and to gold, and that have no other alternative. And I think that is what matters to me, is as I look at the global monetary picture, is that if I had 2% of global currencies in destruction mode, in internal destruction mode, 25 years ago, right now that figure has risen to about 15 to 16% of all global fiat currencies. So if we look at what is happening globally, we look at it relative to the dollar, without understanding that the dollar obviously is losing purchasing power. The inflation in dollar terms is very elevated, but at the same time, that is happening to many other currencies. Tell that to the Japanese, who were told that they had found the magic formula that would make their currency strong and at the same time increase massively their financial and fiscal imbalances. So I think that is what's going on, and the liquidity aspect is what, let's say, prevents gold from reaching the potential that it could reach based on the fundamentals that you outlined as quickly as we would imagine.
And you've rightly outlined, it's all about liquidity. And I think when we look at the US, and I think specifically Bank of International Settlements, most other central banks now, interestingly, have reversed out of the over 50-something years that when Nixon took gold off the convertibility to dollars to gold convertibility, the COMEX was formed 2 years later. And one of the many things about it was you can create a lot of liquidity. It's paper market liquidity. And I think what's interesting here is when you almost limitless amounts of paper market liquidity. And so what's interesting here to me is now that that Basel III NSFR standards have been imposed on the rest of the globe outside of what's going on in the US, which is non-compliant at this point. What we're seeing is an inflection point I believe is an opportunity point, because tomorrow, and I'm sure you know, the Fed has an open meeting to discuss the final implementation of Basel III international regulatory framework on the US. And I think it finally brings the United States into compliance with, obviously, any bank that's got 100 billion or more of total assets, which includes all the Fed banks, agent banks. I mean, essentially, what that does is start to bring potentially, because if you're going to do that, you're going to also have to be compliant for gold and all other asset classes. Now, I'm not saying that would happen overnight, but it's interesting that this is all seems to be happening at once.
Yeah, I think that what you're mentioning is critical, is that all the stars are aligning. And if we don't pay attention to how many stars are aligning at the same time, we might miss important opportunities in a very short period of time. Because this is another important thing that many people fail to get, is that the movement in price is likely to happen very severely and very quickly. It's not going to be, let's see when the trend starts to change, because and you just have to look at the chart, or the gold chart is a very interesting chart always, because you see big moves very quickly, and then a relatively stable period of time, throughout a period of time. So stars aligning, the regulation that you just mentioned, obviously central banks tend to do with regulation what they, what fiscal authorities do with taxes, okay? Interpretation. But being serious, regulation is very important. The change in dynamic about what is a reserve for numerous central banks all over the world. The debasement of fiat currencies that is accelerating all around the world. And at the same time, an environment in which it is very evident that the monetary policy marginal return is lower and getting to be negative. Think about this. The Eurozone in the middle of the European Next Generation Fund, which is newly printed money to start with negative rates for a decade, with a balance sheet that is almost double that of the Federal Reserve, the European Central Bank, with all of those things in recession. So all those things are starting to align to tell us that from a fundamental perspective, we look at supply and demand, and precious metals, gold in particular, certainly have a very, very interesting and quite tight environment of supply relative to demand. But also from the monetary aspect, we're seeing an important change globally about what the world perceives as an acceptable reserve to support the national currency.
And interesting, another thing, and obviously one can make of it on one way, because it's already been, Reuters have already come out and said it's not going to happen. But we have over 40 nations that have expressed an interest in joining the BRICS Plus trading bloc next month at the August summit. I mean, obviously, there's been a lot of pushback about that. Oh, no, they're not going to discuss a global currency. Well, hang on. That's not what our contacts are saying in Russia. And so it's interesting, because obviously Reuters is also a mouthpiece for the US government. I mean, clearly, they're not going to, they're going to try and play this down. But what's interesting is that and I'm not saying this is for sure, a gold back or partly gold back commodity currency for trade between these nations, it would actually be the glue that would bind this trading bloc together. And it cannot be ignored. And I think, obviously, the yuan, the ruble, it's not liquid enough to ultimately, and these have capital controls. I've heard you talking about this. They're not liquid enough to ultimately replace trillions of dollars of energy and commodity trade between these nations. But ultimately, there is really only one solution. It would be an alternative gold-backed, partly gold-backed commodity currency. I mean, your thoughts on this, Daniel? Is this another factor we should be looking at?
I think it is a factor that we should be looking at. I think it should not be shrugged off, certainly. I also think that right now there is no alternative to the US dollar. And the main reason why there's no alternative to the US dollar today is because everyone that could be a contender is making the same mistakes or worse than the Federal Reserve, and therefore, why bother? No? If I want an alternative, it has to be a real alternative. And the reason why it shouldn't be shrugged off is not because this may work, but because the idea makes total sense. You see what I mean? It's not that the Brazil, Russia, India, and China currency is going to work, and I will explain why I believe it won't. Is that they're onto something, is that the idea makes sense. I know that the execution will be wrong because they implement capital controls on their own citizens, and because 2 out of the 4 have a history of destroying the purchasing power of their own currency, only comparable to that of Turkey. That is the reason why I believe that it will not work. And I say, if anybody allows me the joke, I call it the Beatles with 4 Ringos, with all the due respect to Ringo. Now, the problem is that everybody is shrugging it off because they know that a combination of the yuan, the ruble, the Brazilian real, and the Indian rupee is very unlikely to work relative to the US dollar because of all those things that make a fiat currency be demanded are not there, which are, to start with, independent institutions and free flow of capital and investor security. But those things change. Those things change. And what's more important is what you said, is that when citizens are told that somebody is thinking about a currency that will be backed by gold or backed by gold and commodities, citizens understand that that makes more sense than a currency based on faith. People do understand it. Now, you may question whether the ones that are willing to implement it now are the ones that will succeed or not. But the fundamental idea of a nation's currency having a true collateral in wealth and wealth creating proven commodities, whatever you want to call it, is very understandable by citizens. So the formula makes sense. The implementation, or the ones that will implement it, may not make sense, which is the debate right now. The debate right now is about who is going to implement it, not the idea. And I think that the idea makes total sense. Now, this may be very well like what we are living right now. We are living right now in our conversation the success created by a failure, the success of this platform with which we are talking, with all the technological advances, comes from the failure of the velociraptors of Enron. That doesn't mean that, you see, that the idea was wrong, but the implementation was wrong. So it should not be shrugged off. I think that the reason why central banks all over the world are buying more gold is precisely because they're not stupid. Nobody in a central bank is stupid. And therefore, we should be consistently reminding people of the importance of sound money as the way to gel all these ideas that are floating around, that we may agree or disagree, that doesn't matter. That doesn't matter, to be fairly honest. What matters is that citizens know today in the United States that they have full employment and that their wages are getting negative real growth. That's what they know. What they know is that the money that they receive, the purchasing power of the units of currency that they receive, is coming down all over the world. And that's, therefore, I think it's a very important time to not just simply shrug off the idea of sound money, but to remember that sound money is not just a novelty, but it's what should be money to start with.
And this is a process. And as you've said, this is a process. So obviously, I think what you've discussed, I mean, it's good to have your opinion and your view on this, because it's a very considered view. And I think, so on the other hand, we've got global central banks openly and off the radar. Monetary gold does not have to be disclosed when you buy it. And we strongly feel that China's reserves and Russian reserves, physical gold reserves, are a hell of a lot larger than disclosed. And I think we see other central banks also accruing gold. Now, I think, yes, and I think as these things evolve and as these ideas start to take hold, I think at the margin, it doesn't take much at the margin to alter the dynamics. And I think, yes, of course, do you think China wants to destroy the dollar? Of course not.
No.
I mean, it would shoot themselves in the foot. So, but over time, once you implement these things, and there is you can come to some sort of agreement where you can use a stable currency, which is used outside the dollar for trading amongst yourselves. But you're bartering, if you were to call it bartering, using something you can trust. This is a process. So it's interesting times, I think, as well.
Absolutely, absolutely. And China has a very long-term view about things, very long-term. They know all of the challenges that I mentioned before, with a little bit of humor and with whatever, but they know them. But those things change. You have capital controls, you don't have capital controls. 60% of the European Union countries had capital controls only 35, 40 years ago. That changes, no? Confidence in the stability of the currency, that changes as well. The moment that the Central Bank of China lets the yuan float without a fixing, it takes a few years for the market to say, "Hey, I trust this valuation." No?
Yeah.
And again, China's view is for the next 50, 100 years, maybe. I don't even think that far away. I'm not going to be there anyway. But the point that I'm trying to make is that from the Chinese perspective, they need to basically follow a number of steps in the process of becoming not a global reserve currency. I don't think that China wants to have the global reserve currency. I don't think that they care about it. But I think that what you just said is more important, is that a country that is going to rely on massive imports for a very prolonged period of time, and that is moving from an economy that is based on exporting to an economy based on consumption, understands that in that process, having a way to manage the external account, the part of GDP that is created by exports minus imports, if those imports are going to be financed with a currency that is stable and that is backed by gold and commodities, then certainly is going to generate a much more strength when looking at the ability to grow over time. the Chinese mentality is fascinating because of how different it is from the Western mentality. And it's interesting how they look at fiscal balance from more or less the same perspective that we do, but they look at trade balance in a completely different way than we do. So they look at trade balance from a perspective of Chinese strength relative to the world, Chinese weakness relative to the world, not the way that the United States looks at it, which is, hey, other people build cheaper things for us and we have a negative trade balance. We're fine with that. It's a very different view. No? In order to grow over time and continue to support an economy that is very centralized, it makes absolute sense for China to look at a process in which there is some form of management of the trade balance with its own or with a new or more stable currency than the US dollar, in which they see a government that is completely unable to reduce the deficit. I mean, we've just looked at the expectations of the congressional office budget. I don't remember how it's called. The congressional budget office. The projections of deficits for the next 20 years are a trillion at least a year. No, so China must be looking at different aspects of how to manage that trade balance.
Right.
One was the Belt and Road Initiative. That wasn't very successful, to be fairly honest. Not a very good idea. Not a very good idea to lend to people that tend not to repay you. But hey, the second was is to look at this. But it doesn't have to happen with Russia, India, Brazil. No, it can happen in a much more flexible way with different partners, as long as it's fully backed by commodities and gold. So the point that I'm trying to get to is that me being the first that understands that the possibility of dethroning the US dollar right now is virtually inexistent. Shrugging it off is extremely dangerous.
Another thing. Switching tack slightly, that's very interesting and really appreciate your view on this. Now, something we're experiencing in this country, and I think this is something which I want your thoughts on. We have just witnessed the banking system becoming highly politicized. Now, if it had not been for Nigel Farage, who, by the way, I know and have appeared as a guest on his show with, had Nigel not used his GB News platform to expose the reasons he'd been debanked because of his political views, and that because they varied from Coutts, and which is a subsidiary of NatWest Group, and worse, what he'd found out because of the feedback, this debanking exposed literally tens of thousands of other bank accounts who'd been closed for non-banking issues. This is huge. And obviously we saw the CEO, Alison Rose, forced to resign today. I think their shares went down 3% or something. But a bank account, to me, this is the issue. I think this is the bottom line. A bank account is a utility, as important as having water or electricity. When you start playing these political games, where are we going with this, Daniel?
I think it is very dangerous. And I knew of people that suffered the same thing before it became news. And it's very dangerous because when a bank, you've mentioned what it is. It's a public utility.
No, it's public information.
Exactly. When a bank decides to put other objectives, whatever they are, in front of the support and and the defense of their own customers, it is basically destroying its own business. And it's very and again, it's very dangerous. One thing, obviously, we understand that, hey, if you have connections with the mob, you might get your account frozen. Okay, fair enough. That's perfectly logical. But we're taking a very dangerous step forward here, which is a completely discretionary decision to simply close the bank account of somebody just because you don't agree with their political views. Now think about that. If that it starts to become a norm, no, it makes it basically, to start with, it's going to make, you see, let me just go back where I was trying to get to. When a bank does that, usually when a bank or any entity does something like that, it tends to believe that the rest of customers are not going to worry because it doesn't affect them. However, when the rules by which we are all, we receive for our services, for our utilities, etc., it start to be discretionary and completely because of things that have absolutely nothing to do with what is logic, the rest of citizens don't react saying, it's not going to affect me. They react saying, I'm out of here because it may affect me and I don't know why. No? Very, very dangerous. Again, in a moment in which banks should not be playing, even putting the slightest doubt on customer confidence, when they have the largest threat ever in the banking system history, which is central bank digital currencies in front of them. It's very, very dangerous to start playing around with what gives a bank the power to continue to provide this public service, no? Which is the confidence of citizens. Now, if on top of putting under question the confidence of citizens, they have in front of them a serious threat like central bank digital currencies, they might be staring at the end of the banking system as we know it in the face.
I wondered if they were even connected, because I think it just, to me, a bank is a bank. It has no business doing anything other than banking. Yeah. And now they even admit that what they do is they are actually tracking clients who they think of. I mean, this is clients dealing legally, not doing anything illegal.
Absolutely.
They're tracking their social media posts, which, if they do not agree with, are a trigger to possibly pull their accounts. And again, to me, because a bank account, you cannot survive without a bank account. It is a utility as important as water or electricity. This is very concerning. And as I say, I wondered if, as you just mentioned, CBDC, central bank currencies, is this somehow, am I being conspiratorial to think this may all be connected?
No, I don't think so. I think it's different, but the same thing. No?
Yeah.
But this is my problem with when you have a business that is a rent-seeking business or a how do you want to call it? Rent possession business is the best way to describe these types of companies, and not from a negative perspective. You basically generate revenues because you have a certain position in an area or a city or wherever. When you have that kind of business, the managers need to understand that the likelihood of losing the confidence of customers in its entirety and making your business collapse, that happens faster than its ability to implement repression measures like the one that you just mentioned. So, if I am the CEO of the Daniel Lacalle Bank and I have a 20% market share in the UK, and I decide that the people that like disco are not going to be allowed to have an account because I hate disco and I like rock and roll. My business disappears before I am able to cut out of an account the people that don't like disco. I don't know if that makes any sense.
Yeah, it does.
Is that position when businesses always fail to understand that they disappear earlier than the measures that they take to give a worse service to their customers. And a bank, and we know how, and a bank, out of all those businesses, from a utility to a restaurant, you name it, out of all those businesses, this is what banks don't understand, is that a bank disappears faster because the equity of a bank is much weaker relative in its balance sheet than any other type of business elsewhere. We have seen it with Silicon Valley Bank. It had 21, percent deposits to investments or whatever it was. I don't even care. We have seen how quickly the equity of a bank can disappear. So trust is critical. And the decision to hurt customers is absolutely negative. And I'm going to go further with the thought is, imagine that there are 5 banks in a country and the 5 of them decide to implement these measures and take accounts from people. Okay. I'll tell you what happens. This is what they don't understand. Is that the 5th is going to take the market share and change the strategy before the entire thing is implemented. They don't understand the business that they're in many times. They take for granted the number of customers that they have, the deposits that they have, etc., etc., etc. But and I come back to the point, the equity of a bank is I had one of my ex-bosses used to say that bank equity is the let me come back to exactly the phrase. It was the glimmer of hope between its assets and its liabilities. So be very careful with playing with that glimmer of hope because it disappears earlier than the ability to implement those repression measures.
That's very well put, and that puts that nicely into perspective. And I think as it happened in this particular instance, had Nigel not had such a foghorn ability to disseminate this, and it suddenly we see proof, or we get reports of that 10,000 other people have been debanked, and then we find that the bulk of those, it wasn't necessarily political views for those, it was because they deal in cash. And I think that's another interesting point, that this starts to be exposed. And you pull the lid off one thing and it leads to other things. And so that's why I'd mentioned this central bank digital currency thing, because obviously they don't want cash. I mean, if I use cash, I'm a criminal. I mean, I've got ill intent to use my cash, So interesting.
That is very interesting. We live in an era in which financial repression is supported by the idea that it's all about security, which starts from a wrong premise, is that everybody that uses a tool is because they're doing something illegal. No, if I use cash, it's because I want to, and you cannot say that that everybody that uses a car is going to use it to commit a robbery and run away. No, the same way you cannot accept that with cash. But the fight against cash is always predicated on this false truth, which is, hey, like the one against cryptocurrencies. No, hey, they're used for illegal activities, but so is the dollar, so is the euro. By the way, to be fairly honest, not to be fairly honest, it is an empirical fact that the vast majority of illegal activities all over the world are conducted in US dollars. That doesn't mean that the US dollar is negative. That doesn't mean that using dollar bills is negative. And certainly doesn't mean that a bank has any right to assume that a large number of cash transactions or a short number of, I don't care. It's not their job to do that. Their job, by the way, is to manage their balance sheet properly. And in that, unfortunately, we have a history of seeing that banks fail miserably.
Well, I think, Daniel, you've been so generous with your time. This has been extremely informative. I think I just finish up on gold. So basically, and I think I probably know your answer because I know what you're about. But essentially, is it advisable from an investment point of view or a wealth preservation point of view that people should have some exposure? I'm not sure what percentage you think it might be, but some exposure to physical gold stored safely.
Yeah. I am 100% sure that a lot of our viewers are familiar with the way in which you manage a football team. If you want to have a successful football team, you need to have strikers, and you need to have a defense, and you need to have a goalkeeper. Gold is the goalkeeper in a portfolio. You need to have defense and goalkeeper because we all see markets every day, and we see them volatile and going up, going down. But in an environment like the one that we're living in which bonds and stocks are so correlated, that as you said in 2022 and now, in 2022, stocks and bonds fell in unison, and in 2023, stocks and bonds rise in unison to the point in which the most volatile and most risky equities, technology stocks, rise with bonds at the same time. Then you need to have a truly decorrelated asset that preserves wealth over time, and that is gold. So for those that like football, and I'm getting into very deep trouble because I know nothing about football or soccer for our American friends, I'm sure that with all my lack of knowledge, that no successful football team or soccer team has ever survived without a goalkeeper. The same with a portfolio. You need to have a percentage. The percentage obviously is not dictated by me, but by the client or by the investor's exposure or tolerance for risk and volatility. But you certainly need to have it. Absolutely.
And I probably think you might add some exposure to silver would not be a bad idea as well.
Well, yeah. I come back to the dreadful football or soccer analogy. Defense, okay? Silver, gold, palladium are there in the defense of a portfolio. So is the US dollar, by the way, because everything we have in a portfolio that is in stocks and the highest beta exposed stocks is a huge bet against the US dollar. to start with. No, if we look at the market is long something, short the US dollar. That is what it is. No, that is your pair, and you need to have some exposure to the US dollar. So yes, silver absolutely, platinum, and obviously, but and this is an important element. Gold is proven to be money in periods of challenging times, etc. Silver, less so. Not that it is not, but less so.
Well, Daniel, thank you so much. You spent a wonderful hour with us here. I do appreciate you very much coming in and giving us your view, which is a well-considered view. And I think people will very much appreciate that. It's all about education. It's all about knowing stuff. And I think when you know stuff, you can make better decisions. And I think, thank you for bringing that to us today.
It's been an absolute pleasure, Andy. Great pleasure to speak with you. Thank you very much.
Thank you.
All right. Thank you, Andrew Maguire, and special guest Daniel Lacalle, for another fascinating discussion. And remember, buy physical and make sure it's 1-to-1, and understand the difference between what Andy affectionately calls the casino, paper, and gold and silver markets, and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault. And please help spread the word about this channel by hitting that like button right there if you haven't already done so. Share this information and make sure that you subscribe. Now, if you want to be notified in real time as each episode goes live, just click on that bell and we'll do just that. And with that, we'll see you right here next time on Live from the Vault. See you then.